In this presentation, we will work a fairly comprehensive problem comparing the general fund and the government-wide activities. We're going to start off with the general fund, and we're going to compare side by side as we record transactions to the general fund. Then we will compare and contrast them to the government-wide activities. Remember that the general fund is on a modified accrual basis, government-wide activity on more of an accrual basis. So the government-wide activities should be more of what we would be familiar with from financial accounting, and the general fund with the modified accrual will have more of the unusual activities. We'll start off with one of the more unusual activities, that being the budgetary accounts. So we're going to have the estimated revenues and the appropriations. We're breaking out the estimated revenues and appropriations by category with regards to the revenue. Taxes, licenses, intergovernmental, miscellaneous. Of course, this is revenue to the government. Then we have the appropriations, similar to expenditures or expenses that we're estimating. We're allocating resources in accordance with these categories: general government, public safety, public works, health and welfare, miscellaneous. And when we post this information, which we will actually do, we're actually going to post this being the unusual thing. Budgeting, not unusual for financial accounting or normal type of accounting. Posting that budget to the general ledger, however, is unusual. So we're going to be very transparent within the governmental accounting by trying to put everything out there and say, hey, this is the budgeted revenue. These are what the appropriations are going to be. We're going to post it actually to the general ledger, which again, a bit unusual. We're going to have the trial balance. We're going to use this worksheet in order to record this information. We got the debits are going to be the positive number or unbracketed, the credits being bracketed or negative numbers, the debits minus the credits equaling 0. We're going to have the green area being the assets, the orange area being the liabilities, the light blue area being what would be equivalent to the equity section, or in terms of the fund accounting, assets minus liabilities, the net assets type of section, net position type of section, the fund balances type of section. And then we have below that what would be the income statement account, the temporary accounts that would close in at the end of the time period to the what would be the equity section, that being the same for the governmental accounting. However, included with the inventory or the income statement accounts like revenue and expenditures, we have the estimated revenues, we have the appropriations, and then we have these encumbrances we're going to have to deal with, really muddying up the waters in some ways, but being more transparent in others as we post things, such as the budget. So now we're gonna post this information. Therefore, we need to determine which of these accounts are going to be the budgetary accounts. We see that revenue is what would be normally revenue. The one that says estimated revenue is, of course, then the budget account related to revenue. Revenue has a credit balance. The budgets will be opposite to their counterparts. That's how I would think of them. So revenue has a credit, therefore the budgeted or estimated revenue will have a debit. You'll note that we don't have a separate budget account for each of the line items on the estimated revenue. We're not going to break that out here. We may do so in a subsidiary ledger at times. And so we're going to record it on one line item and possibly break out in a subsidiary ledger the detail of the categories. And then the other side is going to be the appropriations. That's going to be similar to the expenditures or expenditures. Expenses have debit balances, therefore the budgetary account, kind of related to it, appropriations, is going to have a credit balance in order to be opposite. And then the difference is going to go to some type of equity account. Remember, when we don't know what else to do with the other account, we usually make some type of equity account, and we're posting the budget, which is really kind of unusual. We have the debit and credit, then we have the difference, which would be kind of like budgeted net income. And so that's going to go to the equity account. We're going to have to make up some type of what would be equity account, net asset type of account. We're going to call that the budgetary fund balance. So here's what we're going to do. We're going to say estimated revenues, debit, credit the appropriations, the difference, the revenue estimated over the appropriations estimated, outflows, expenditures, allocations, giving us that estimated kind of net income, which would be posted to the made up equity account that we made, which is the budgetary fund balance. If we post this, then we got estimated revenues going from 0 up in the debit direction, the estimated expenses or appropriations going up in the credit direction, and then we have the budgetary fund balance taking the difference in somewhat kind of like the equity or net position balance, it going up in this case in the credit direction. As we add up the debits and credits on the bottom side, what would be the income statement accounts, remember, we're going to have to group these a little bit differently. We may want to group them between here's the budgetary accounts, debits minus the credits, and here's the revenue and expenditures accounts, debits minus the credits. You'll also note that we have this encumbrances from year 1, which we're going to say is the prior year. We're going to say that we're currently in year 2, and it's kind of hanging out there. Like the post-closing trial balance still had encumbrances, which normally you would think of being 0 in the beginning of the time period, because they're a little bit strange. Those are, I'm going to call them more of a clearing account as opposed to temporary accounts, which would close out to the fund balance. So in this case, we have encumbrances from the prior year, year 1, still hanging out here in an account, which when looking at the trial balance, we would think, hey, that's a temporary account, which I would have thought would closed out. But encumbrances are a little bit different because once again, they're a holding account, which are holding that item until we record the related expenditures. That's going to cause us some issues in the future we'll have to deal with. What about the governmental activities? What do we do with recording the budget? Nothing, because governmental activities is going to be on the accrual basis. We're not going to deal with this budgetary kind of weirdness. We see no budgetary accounts down here, no budgetary fund balance type of account. That's nice. Next item, we're back to the general fund, modified accrual. We're going to say that we have encumbrances issued against appropriations. So we have the encumbrances issued. So again, that's going to be another one of these little bit more unusual type of activities, the governmental accounting trying to be a bit more transparent. And what this means is we have estimates, or we can compare them to like purchase orders that we would have for profit, where we would basically say, hey, I want inventory, and therefore I'm gonna send this to the supplier, a purchase order, and say, hey, we would like this inventory, but we haven't paid for it yet. We haven't got the inventory yet. It's just basically tracking the request of the inventory, and therefore for profit doesn't post it because there's no financial transaction. No inventory has been received, no payment made. Here, however, we are in essence going to post that activity. And again, the goal is to be more transparent. We're trying to say, hey, we've allocated these resources. We've kind of committed to it in a way. Therefore, we're going to record the encumbrances on the books, even though a financial transaction in terms of accrual accounting or cash accounting hasn't yet happened. So this is going to be an unusual type of transaction where we're going to use these encumbrances accounts. We're going to put it into the encumbrance for year 2 to break these out to show this is a current encumbrance happening in year 2 here. It's going up as we would expect an expense account, allocating something that's going to be similar to an expense, but this isn't an expense yet. It's a holding account that we're going to put it into until the point in time when the financial transaction actually happens, at which point we will record the expense related account expenditures and reverse this encumbrances account. Therefore, we're going to have to put the other side again somewhere. Where are we going to put the other side? Well, we're going to make up an account that we're going to stuff into what would be more like the equity type account sections, because that's where we put stuff usually when we're doing something a little bit unusual. So we're going to put this encumbrances in the other side of it. So we've got the encumbrances is going to be debited for year 2. We're going to say that's the current year. That's the year we're in, year 2. And then we have the encumbrances outstanding, year 2. Notice these are always going to be equal and opposite. They're equal and opposite because they're just a holding account, and we're going to have to reverse them exactly when the actual expenditure happens that's related to that encumbrance. It's basically putting on our books here so that anybody that reads them can see it and say, oh, this allocation has already been made, although no financial transaction has yet happened in accordance with the modified accrual basis for expense recognition. How about the government-wide activities? Once again, nothing's happening there because we're on more of an accrual basis and no transaction has happened. You'll notice that we don't have the encumbrances at all. We have actual expenses here, and we're going to wait till the expenses are recognized to record the government-wide type of activities. Back to the general fund. We're going to say that there's a tax levy and the amount that's going to be uncollectible. This, of course, will be the revenue type of idea of items. We're going to be collecting taxes for the governmental items. So this will be similar to, say, sending an invoice out if it was for a for-profit type of business. We're going to think about, well, we're billing kind of the clients. We levy the taxes on the client. and therefore we're going to be putting this into a receivable because they haven't yet paid us, so we're going to put it into a receivable. And the other side, of course, we would think of as revenue. However, we're going to record the uncollectible portion at this point in time as well. So the transaction is going to be receivables going up. That's how much we levied for. That's how much we expect to get. That would be similar to us basically sending an invoice out for that amount. We think that we're not going to get $74,000, therefore making the contra asset account of the $74,000, the difference between the two, what we expect to receive, we're going to record that as revenue. Note this is pretty much an accrual type of transaction. We're recording the revenue here on basically an accrual basis. And at the end of the time period, in some cases in the general fund, we're not going to be focusing on this component here. But in the general fund, we may want to reverse that or need to reverse that to be to the modified accrual basis, which would be more on a cash basis for the income statement type accounts and more on an accrual basis for the balance sheet accounts, meaning accounts receivable is going to be a balance sheet account. We want to keep that. The revenue account, however, we're going to possibly want to reverse out to bring it more to a cash basis. So be aware of that. If we post this item, then we're going to say that the taxes receivable, the receivable account is going to go up. We're going to then record the contra account, saying the amount that we think is going to be uncollectible. The difference between the two is what we expect to collect and is what we're going to record then as revenue. So that's going to be that item. What about the government-wide activities? Well, that's in essence an accrual transaction. So the government-wide activity is going to be pretty much the same. We're going to debit the taxes receivable, credit the allowance, and then the difference is going to go to our revenue account. Only difference being we're a bit more specific on the name of the revenue account: program revenues, general government. So same activity, the receivables going up, the allowance is going up. In the credit direction, because it's a contra asset account, difference between the two, what we expect to receive, the difference then also going to the revenue account, increasing that. Back to the general fund, where we're going to say that tax collected for the current year is this amount, and then delinquent taxes that are going to be collected is going to be the 141. So now we're going to say that we actually had collections. That means that cash is going to go up. That's fairly straightforward. And the other side is going to go to the receivables. So we're going to be reducing the receivables in this case. Pretty straightforward accrual type of transaction. Cash increasing, and then we're going to be reducing the receivables, taking them out between the current receivables and the delinquent receivables. So if we repost that, then we're going to say cash is going up, and we're going to say the receivables current, and then is going down with the credit. And then we have the delinquent receivables going down. Only difference here is that we're breaking out between the current receivables and delinquent receivables. What about the government-wide activity? Well, in essence, that's going to be the similar or same type of transaction because this is more of an accrual type of transaction. So we're going to say that cash is going up. We have the decrease in the receivables as well. So cash increasing, the receivable then decreasing with the credit, as well as the delinquent receivable decreasing with the credit. Back to the general fund. So now we have costs during the year. These are going to be items where the encumbrance is not recorded. We're going to call them payroll items here. We're going to say that there was no encumbrance related to these. In other words, the budgetary account, in other words, the encumbrance account that would be set up when we have the estimated or the invoices are going to be items down here that we would then have to reverse if we had expenditures that were related to them. These expenditures, we're going to call them payroll or wages related expenditures, weren't previously encumbered. They're not included then in the encumbrances, and therefore we don't have to reverse the encumbrances, but can do the more normal type of transaction, which is simply to record the expenditure type transaction, those expense related type of items. You'll note that we have the grouping here of the general government, public safety, public works, health and welfare, miscellaneous. We're not going to be breaking them out into those groups within this transaction in the general fund because we typically will have a subsidiary ledger, and so we're just going to put them into the one line item at this time. That's going to be expenditures for the total amount. The other side we're going to say is a payable amount, so we're going to say it's into vouchers payable. And that'll be a liability type of account. So if we record this out, then we're going to say that the expenditures, this is going to be the expense related type item. We're going to put everything in there on one line item. It's going to be this item increasing the expenditures. If we were to group then the accounts that are going to be the income statement or the below what would be the equity type of accounts, we have budgetary accounts, we have income statement accounts and we have this encumbrances, we could then group together the budgetary accounts and net them out, and we can group together the revenue and expenditures type of accounts, which are going to be the revenue and the expenditure type of accounts, and we can get basically a comparison between the two. So just note that as we consider what would be the equivalent of kind of net income down here, we've got to deal with the fact the budgetary accounts are down there as well as the encumbrances. And then the other side is going to increase the liability of the vouchers payable. We've got a credit. We're going to increase it in the credit direction. What about the government-wide type of activities? Well, we're going to have much the same thing, except now we're going to break out the detail in more detail in terms of the expense type of accounts rather than the expenditure type of accounts. So we're going to have the expenses for the general government, the public safety, the public works, and health and welfare. We're going to break them out individually now, and then the credit will be the same amount of the total. So we just have basically more detail, same type of activity in that we're basically in essence debiting the expenses and crediting a liability type of account. If we were to post them out, then we're breaking out between expenses rather than expenditures because we're on an accrual basis rather than modified accrual, increasing in the debit direction for expense accounts from 0 going up. And then on the other side, we have the vouchers payable. And of course, calculating the revenue over the expenditures here is pretty straightforward because we could just see the credit of 2002100 minus the expenses 432000 minus the 644000 minus the 263000 minus the 448, and that's going to give us the 215,100. Notice we could just do that by summing up the credits minus the debits within Excel. So this would be a fairly straightforward kind of way that we can see this, of course, with just having basically income statement type accounts below what would be the equivalent of the equity account, the net position type of account. Back to the general fund. Invoices for items ordered were received and approved for payment in the amount of the 14,650. That should be a comma, not a period. And then we have the encumbrances had been recorded in the prior year for these in the amount of 1490. Okay, so what this is trying to say here is that we had the encumbrances for the prior year recorded, and that's where that 14,090 was basically still hanging out in what we would think of as would be like the income statement type of accounts, temporary accounts. It was still there and not 0 as we would expect it to be if it were to be closed out, and the related encumbrances for the prior year, year 1, equal and opposite in what would be basically the equity section there from last year. So now we're saying that we've collected, or we're making the actual expense, we're paying them off or recorded the expense has been triggered, or the expenditure in the current year. So now we're going to basically clear out the encumbrance for the prior year based on the estimated amount, and then we'll record the related expenditure based on the actual amount. So remember, the encumbrances are going to be something that typically I would call a clearing account. They're going to go up from 0 up and back down to 0, not typically based on a normal kind of timing account based on closing out to the equity section, but based possibly on something different, which is in this case is going to be when the actual expense happens. So what we're going to do is we're going to reverse this out, and this is going to be reversing the encumbrance. We're going to separate the encumbrance for year 1. So we're going to credit the encumbrance. So here's the encumbrance. We're going to credit it to make it go down to 0. So that's going to make it go down. The other side's going to take it off the equity section. So we're just in essence removing the encumbrance that was on the books from the prior year, the holding account that was holding it before the actual expense was ready to be recorded under the accrual method or the cash method or the modified accrual. That takes this back down to 0. So now we've removed that amount. Next thing we're going to do is record the expenditure for the actual amount. So the actual amount was this. Remember that the encumbrance is an estimate. So, and this gets a little bit tricky, what we're going to do in terms of breaking it out between the 2 years. We're going to say that the encumbrances, the expenditures that are related to the year 1, encumbrances are going to be the 1490. And then the expenditures for year 2, we're going to say is the difference between the two. In other words, we applied out the 1490 last year based on the estimate. Actual amount was the 1460. The difference is going to be the 560. So in the current year, we're recording both expenditures, applying them out, and breaking them out for the detail here showing the expenditures applied to year one, the 1490 that were encumbered in the prior year, and then the difference between them being the 560, and then the credit being vouchers payable, assuming we haven't yet paid them, increasing a liability type of account. So this would be more of the normal type of transaction we would have, debiting expense of some kind, crediting a payable at the point in time that we've actually incurred whatever it is that is there, but we had to reverse the encumbers last time. And because it was an encumbrance from the prior period, it's even a bit more muddied to do that. So if we record this, then we're going to say that the expenditure, these two expenditures are going to go up. So these are kind of the expense related items, increasing them, decreasing the revenue over the expenses amount. Other side, increasing the payable. So the payable increasing. How about the government-wide activity? Well, it's much more simple. We'll do what we would expect on an accrual basis. We're going to record the expenses and we're going to apply them. We're going to say that they're applied to the public safety category. We're going to categorize them expenses rather than expenditures. We don't have to do anything like reversing encumbrances because encumbrances aren't something that we would record on a normal accrual type of accounting, which the more government-wide type of activities is on, and therefore we just wait till the expenses would be incurred under an accrual basis, and we're recording them at this time for the actual amount, and then the other side in this case is going to go to vouchers payable, assuming there is a liability we have not yet paid for them. So we're going to increase the expenditures, we're going to group them in a specific category. We're saying here it's for public safety. Other side going into the vouchers payable, increasing vouchers payable in the credit direction. Back to the general fund. So now we're saying that we have incurred the expenses related to the encumbrances for the current year, or at least part of the encumbrances for the current year. In other words, in year two of the current year, we put in or put a reserve or put the encumbrance in place for the 976,510. We're going to then say that some of those amounts have now been received. And note that if they've been received, it might not necessarily be the case that they all happen at one time. So we might not like reverse this entire amount at one time. We got to figure out how much of the encumbrance estimate has been received now and compare that to the actual. So this was the entire amount of the encumbrance. Then we got to say, okay, we've received some amounts. We have to reverse the portion of the encumbrance amount. And then we have to decide what the actual amount is because the encumbrance is an estimate. The actual might be different. So we have two columns here. We've got the estimated liabilities. This is the amount that was included in this 976,510, and that's going to be 869,200. So in other words, of this 965,510, on estimated dollar terms, we have 896,200 that have been received and therefore need to be reversed out of the encumbrance and reversed out of the encumbrances outstanding. Then we have the actual amount, which is different than the estimated amount that we're actually going to record at the point in time that we would normally record under a more normal like accrual method, modified accrual in this case, and record the expense and the related either payable or cash. So first we're going to say a debit to the encumbrances outstanding, reversing that, and credit the encumbrance. So if we post that out, then we have the encumbrances outstanding. We're going to make this go down. This is in what would be like equivalent to the equity section, reducing it. And then we're going to reduce the encumbrances down below, which is in kind of the income statement type of area, but remember isn't an income statement item or a budgetary account item. It's basically just a holding account until the expense is actually recognized. Here it is. Now the expense is recognized. Therefore, it's going to go back down. We still have 80,310 for which the expense isn't recognized, and we still have the holding account in place for it. Next item we're going to do then is to record the expenses, this being the more normal type of transaction with the actual costs, which is going to be different than the estimated costs, or it could be because, you know, the estimated cost is an estimate. And then we'll record this. This should look more normal, where we actually record the expense or expenditure. In this case, we're going to call it expenditure. Year two, expenditure increasing with a debit, as we would normally expect an expense to do. And then we're going to credit the vouchers payable. It has a credit balance. We're going to increase it in the credit direction. And then what about the government-wide activities? Well, we're going to do more of what we would expect to do and then we'll add a little bit more detail to it, meaning we don't have any encumbrances business, no encumbrances balance in the equity section or in the section in terms of the income statement type of section. However, and we have expenses rather than expenditures, which is nice. And then we're going to break out the detail of the expenses in accordance with the categories. So we're just going to break out the categories here: general, public safety, public works, and so on. And note, as we do this, we're counting the general and the miscellaneous are being grouped together in the general item there. So then we're going to post this out. This is going to be more of a standard type of transaction. We're recording the 3 expenses into their respective expense type accounts grouped by category. The credit then going into the liability into the vouchers payable account.